Hello and welcome to another episode of Multifamily Strategy Live. Welcome to the new studio. This is the new setup. I have a lot more work to do, and these mics aren't even actually turned on or going off the camera mic because
they look good though.
They do, so I left them up. We will build this studio out a ton more, but wanted to introduce you guys all to the new format. Now, I'll be answering your questions through the cell phone today. So as you have questions, answer them in the chat. Caleb and I are going to be running here for probably about 30 minutes. So not a super long episode, but we just had a fantastic conversation filming an episode of YouTube, actually. Wanted to fill you guys in on that and actually have an interaction with everyone live. So if you happen to be watching this Labor Day, first of all, welcome to the channel. If you're not familiar, by the way, welcome to Multifamily Strategy.
Happy Labor Day.
There we go. We talk about creative finance. I bought hundreds of rental properties. Caleb's on his way to 100. He's under contract for what?
We'll pass 100 and maybe 2 by the end of the year. We'll see what happens.
Caleb's accelerating really quickly. We're showing exactly how to run, operate, finance, buy these deals. And I started with no money. So did Caleb. I started with like a few $1,000s in my bank account. Caleb started with $300.
Yeah, less than $1,000.
Anyone can play this game. Anyone who tells you otherwise is incorrect, which brings us to today's topic. By the way, if you're new to the format, we talk about one topic for maybe 10, 15 minutes, probably less.
Around there.
We talk about one topic of the day while everyone kind of logs in, asks their questions, and then we answer questions till the questions stop. Now, today, I'm moving into this house. We're a little bit busier than usual, and we're underwriting some of our deals. We're doing final underwrite and due diligence. So we're going to be coming to you guys live and talking about this topic that I've seen all over online. I posted a couple times on Instagram at Christian Osgood. I completely disagree with this. I've had 3 major online real estate influencers all say this. Cash flow is a myth, which is insane. Buy and hold is not like a super new concept.
It's actually one of the older concepts, I feel like.
So did it just stop working? Are we just crazy? We're going to actually dive into this on today's episode. So first of all, there are 3 things that you need to know. One, the 3 ways to make sure that you're doing the correct deal. You either need to borrow less debt, so borrow less money, borrow cheaper money, and you always need a reserve.
Yep.
So how do you increase cash flow? It's like, okay, well, if you borrow less money, you owe less, your expenses go down, you're going to cash flow more. However, if you're like Caleb and I, you didn't start with money.
Unfortunately not.
So the influencers, I mean, we're talking about like bigger pockets people or real estate guys, so professional wholesalers or flippers are saying you need the active income before you buy the real estate.
Caveat here, we do not hate active income by any means.
No,
active income is I'm a proponent that you should have active income. It's not like go buy your 10-unit, leave your job. It's like, okay.
Much easier if you have an income.
100% agree there. But to say it can't be done without active income is complete BS. Can it? It's going to be really hard, but it 100% can.
Yeah. And it's not that your deal is going to be perfect, but let's hit number 1. It's like, if you have more money to put down, you can retire faster because you've already earned your money and now you're getting a return on that money. If you're buying low down, the only option is to borrow cheaper money, which is where we get into creative finance. Right now, if you're buying a 6-cap deal, which means every dollar invested in the deal yields 6%, and you're borrowing at 7%, you're going to lose money on every dollar borrowed. And if it's amortized, that's actually accelerated. That's really, it's even worse if it's not interest only.
That's going to be really tough. And this is why buying good deals is so important, especially right now.
Yeah.
We're kind of in a weird cycle where the impending election, Jerome Powell announcing rate cuts, whatever you want to say, it's always a fear factor, always a doomsday factor going along with it. We're buying great deals still. Yeah. We're actually under contract on the single best deal we've ever done.
Yeah, $1,008,500
for 44 units in
44
Stephenville.
Units. And these are prime, by the way. If you're like, oh, these are like super slummy units.
Yeah,
they're really nice.
Yeah, are they buying like mud huts?
No, again, Instagram. I've dropped some videos on this already. I'll drop some more this week. So at Christian Osgood, check it out there. But like, I'm dropping a bunch of pictures of these things. They're beautiful buildings, excellent condition, excellent location.
Dude, we have a clubhouse.
Fantastic market. It has a clubhouse. These are great assets. I love the deals that we're doing right now, and they're deals that anyone could do. There's no mystery here. We're finding owners organically. We're just meeting people in real estate who've done the thing we want to do, which is buy and hold real estate. And we are emulating them, and we're learning from them, and we're tapping into deal flow that some of these people have.
In caveat, owners are the best. I strayed away from brokers for a long time. You can use brokers too. You can use property managers. It's a relationship game. I think owners are the most powerful because, well, they actually own the deals. Property managers probably one remove from that, and brokers usually suck. But we found a few good ones finally with some decent relationships, so thank God for that. But yeah, it's just a relationship game.
Yeah, and we'll touch on the reserves in a second because I think that's a big problem that a lot of these online influencers are running into right now. So we will touch on that. I think it's the main problem. But with borrowing the cheaper debt and really just stacking your capital stack correctly, you need to be able to buy good deals that cash flow day one.
Absolutely.
Otherwise, just don't buy them. If your goal was to
actually, I got a caveat to that. For the more seasoned investor, if you're walking into a deal with, let's say, a lot of cash and there's a ton of upside, you might be able to sacrifice cash flow day one. For the starting out investor, absolutely not. Do not sacrifice that cash flow unless there is a clear cut and concise plan to remedy that.
But even then, you can't go negative cash flow if you don't have any money. Like, you just lose the property.
Exactly.
You can't start there. Now, if you have $50,000 a month coming in from passive income, so
that's what I mean. That's what I'm saying. Yeah.
Then you can do a project that may lose $10,000 a month that has a ton of upside. You can play with your global cash flow. But when you're starting, and for the average investor, if you just bought deals that cash flow and you did nothing else
and held them for 35 years,
every time you close, you make more money. What I'm seeing people say online, and I've seen this a bunch of times, they're saying, oh, cash flow is a myth. It gets eaten up by all this other stuff. You need to sell properties to be able to make it. Like, I'd love to be able to keep them, but I can't. That is a symptom of either taking on too much debt, too expensive debt, or number three, you don't raise the reserve. Caleb and I both done this. My first deal, we raised what we need to close the deal. And the deal looks better on paper when you're raising capital. When you're like, hey, look at this is what the deal is. The problem is roofs fail, pipes burst, electric has problems, tenants have problems, tenants bring in bugs. There's all sorts of issues that you can run into with real estate, and there's a way to mitigate them. And a lot of it is we use subsidized housing that actually helps support some of these renovations. That being said,
you can't plan for absolutely everything.
If you have, I like to see 3 months operating in reserve. But if you do a significant capital raise that also includes reserves and your deal still works, which means you can still give your investors the return they want, you still cash flow the deal, and you have that reserve in there, when those things happen, it just comes out of the operating account. You already budgeted for it. It's already allocated. And as you increase rents over time, because rents do move up over time, you refill that account. You can pay yourself cash flow day one and continue to pay cash flow all the way through your deal, only if you have adequate reserves, which again can be raised. Your debt is cheaper than the income the property produces, which means every dollar borrowed is making you money. That's easy math to do, by the way, called loan factor rate.
Don't have to be a rocket scientist.
Yep. Loan factor rate, total cost of debt divided by your total debt, and compare that to the cap rate, which is the purchase price, which is the net operating income divided by purchase price. If the ratio of income, your cap rate, is higher than your loan factor rate, congratulations.
You've got a winner.
Every time you borrow, every dollar you borrow will make you positive income. That's the math. I don't think either there's a lack of understanding there, or there's people who are buying too small, too expensive. And again, it's that online guru thing. It's people who are selling you courses on wholesaling are traditionally the people
who don't like buy and hold.
And they're the people online who are saying you can't cash flow a deal because they want you to buy their course.
And there's nothing wrong with building a business. If you're trying to build a business, go build a business. If you want to own real estate, go hold your real estate. It depends what the end goal is 110% of the time out of 110% of the time.
Yes.
We got some questions coming in.
We have a couple coming in.
Actually, we'll touch on one more thing here. As far as having a reserve, this deal we're doing in Stephenville, we're actually required to put $220,000 of money back in the property over the next 3 years.
Mm-hmm.
And that's just a thing with the state of Texas. Like, that's a regulation Christian and I don't get to decide.
Yep. When
we're buying these low income subsidized deals that are directly correlated with the government, they're like $5,000 per unit of CapEx / repairs. So it's like, okay, we're just going to raise more money up front. Deal still supports it. Check the box.
And that's how it's going to work.
It's not rocket science.
How it has to work. Now, there is one other thing that I think is really important. If you're trying to buy single family or you're buying small multifamily and you believe in the myth of like, hey, I'm going to buy a couple of duplexes or I'm going to buy a few fourplexes and that cash flow is going to let me retire.
Wouldn't that be nice?
That's a myth. You need more real estate. And I had someone get upset with me I think it was on Facebook. They got upset because like, well, people shouldn't just buy 1,000 units who have no experience. Absolutely, people shouldn't do that.
Oh, I know you and I have had this conversation on camera and many times off camera, the dangers of syndicating 100+ units as your first deal.
Or even if you did it without syndication.
But still, crowds, like, nothing wrong with raising money. We raise money. But jumping into a deal with zero experience, I'm all for, I would say 30 and under.
Yeah.
I think you're aggressive with 30, but I like it.
Buy a 12-plex, buy a 25-plex, buy bigger.
Don't buy a 75 unit that has a ton of renovation, a ton of management issues as your first project. And you're like, okay, guys, here's what we're cutting our teeth on. There's probably wiser decisions to make.
Yeah. I mean, that being said, well, my first large deal was 38 units. It was after 2 duplexes. And it had all the problems. Homeless. It had high vacancy, high deferred maintenance. And we fixed it up and we made a ton of money. It depends on what it is that you want to do in your comfort level. I'm not saying you should just risk it all on a big deal, but I'm saying it is not much harder to run a 12-plex than it is a 4-plex. And people take so long to scale. If you are buying small, cash flow to retire is kind of a myth. It's going to take you decades.
Dude, I think on that, though, that's a lot of what people are pushing now. I clearly remember there's a time when I got started where I was talking out with a former business partner, hey, here's what we should do. Mm-hmm. And it was duplex to triplex to fourplex. And then if we got 64 plexes, we'd have over 200 units. It's like, why not just buy a couple buildings? Why go through 60 transactions? And it's this stuff being pushed down people's throat nowadays of start small, wholesale, flip. If you want to, that's awesome. But what is the point? Don't add steps, and everybody adds as many steps as possible, it feels like.
Yeah. If your goal is buy and hold. If your goal is to retire within, say, 3 to 5 years, it's hard. It's really hard.
No one's going to tell you that's going to be easy.
And you can do it if you buy big enough. Again, I'm not saying 1,000 units. I'm not saying 500 units. I would say the average person can retire on, if you're buying good deals, the cash flow.
If you're
50 to 100 unit portfolio should be enough to be able to leave the average person's 9 to 5 and pursue real estate full time, which will allow you to scale bigger, which will scale your income.
If you bought Four Town Creeks / Trinities,
mm-hmm.
Absolutely.
Yeah.
Without a doubt. I mean, those things are going to be spitting out $10,000 of cash flow between investors and operators each. I feel like that's enough for the average person to retire.
I would say so.
Especially like if you're living in a high rise in downtown Los Angeles, probably not. But if you're a normal guy, normal gal, I would say so.
Yeah, absolutely. By the way, ask your questions in the chat below because we love talking creative finance. I go live every Wednesday, by the way, but I figured we'd test the new studio out, give you guys a little sneak peek.
Little Labor Day fun.
Yeah, a little Labor Day fun. Now, we only have one question in right now, and it's from Instagram. By the way, easiest place for me to view them right now is on YouTube until I get my second screen in here so I can actually see your questions on my
Oh, that's going to be really cool.
I know. But the question that I see here is like, okay, so I've seen this a couple places online, and I've done a deal. I'll read the rest of it. That hasn't cash flowed significantly. Like,
did they say what size deal?
They bought a 4-unit deal, and it's cash flowing about $200.
I mean,
how many deals do you have to do for $200 to actually retire? Well, you would have to do a lot.
And that's what we're talking about. Like what I was just saying with like 60 units or whatever. It's like a 4-plex is awesome. Mm. And we had an opportunity to buy a fantastic 6-plex deal in Stephenville.
Yeah.
Looking at the pieces, it's like, man, these buildings are really cool. They're big units. They're nice units. Great location. But doesn't move the needle for us. Mm-hmm. And the answer was absolutely not. It maybe a hair, but for where we're trying to get to and the size stuff we're looking at, no, it's the same thing with whoever's deal this is. It's like, it might be a fantastic 4-plex, and there's nothing wrong. Congrats on getting started first and foremost. But next time, go out and buy a 30 unit. That's how I feel about it. More cash flow. You have 3 vacancies on a 30 unit. Cool. You probably need to get them fixed and filled. If you have 3 vacancies on a 4-plex, we're screwed, essentially.
No, I mean, that's exactly right. It is just like you need to focus on what the goal is and then what is the most efficient path from A to B.
Absolutely.
And I think a lot of people, it's conceptually easier to go, hey, I would like to buy a single family because it's small and it's easy. Or I want to buy a duplex because I can get this conventional financing. And while that's true, if you eliminate all the larger deals, and again, we're not saying buy a Titanic deal. If you're eliminating mid-sized deals, you're only looking at small deals, you're only going to take small steps forward. And while it's okay to move forward, and you can build a lot of reps, you can build a lot of experience, you can build a lot of wealth.
Absolutely.
You just can't hit the goal if you add too many steps from get to A to B. And that's what I learned. I started with a condo, then I bought a duplex, then I bought another duplex. It took me a few years. And guess what happened? I had $2,000 a month cash flow, $24,000 a year. That was a nice supplement to my income. It was about 10% of what I was making in active income. That would have taken me the rest of my career at that rate, 40-year career. I would have bought enough real estate. And then, of course, it would have appreciated. I would have been worth millions. I would have been cash flowing about what I made during my career. And it would have taken me 30, 40 years to build.
Why not just do it in 5 or 3?
Exactly. Just build a business that gets you to where you want to go. That's what I love about real estate. It's not capped. So when people are telling you online, oh, cash flow is a myth, it's like, who has heard of someone who has a positive cash flowing duplex? Obviously can't see your hands, but like,
mine's right here.
Yeah, mine's raised. I know people who've done that.
You've done that.
So if you get 200 of these and they're still cash flowing on the same principles, do you make more or less money?
Shocker. You make more.
You just need to scale a scalable business, just like you need to scale a scalable career. If your goal was to buy a few duplexes, you may have set the wrong target. If it's to buy 5 houses, you might still build a lot of wealth. My wife's aunt and uncle bought 12 houses throughout their career. One of them is in medical sales. The other one owns a couple of massage locations.
Massage MD, massage parlor kind of places, yeah.
And so they saved, and they saved, and they saved, and they bought 12 houses. They cash flowed a little bit, not enough to retire, but they cash flowed a little bit. They ended up selling half of them to pay for their kids' college. Now, they got to keep 6 rental houses. It's awesome. They did a great job. That's moving forward financially. That's making good decisions. Is that financial freedom? That's 12 transactions. Absolutely not. And you have to off half of them. And I think that's what these influencers are talking about online. They're like, we have to flip and we have to wholesale. Otherwise, we run out of money. My argument would be you're not doing deals that make enough money.
Exactly. I mean, well, some of these influencers, though, that started out as kind of on the smaller side that progressed into bigger deals, you don't see them talking about it.
Mm-hmm.
They're buying the multifamily. They're holding the assets. They're holding the deals. If you play in a small pond and you're buying smaller assets and you're a flipper, a wholesaler, note land flipping guy, whatever you call it, you're looking at the wrong playing field. When you're looking at the guys, okay, they're progressively buying bigger deals. They're taking steps forward. They're creating generational wealth. They have equity stakes in these multi-100 unit projects. You don't hear them talking about this.
No, not at all. By the way, when you're finding these people who are really successful, this ties right into the next question. Kashif asks, what is the criteria to find owners? Unit size, ownership length, etc. So
depends on your goal.
People have done what you want to do. Ownership length doesn't matter to me. Unit size doesn't matter to me. I'm looking for people who own rentals in the market that I am buying in. Yeah. I want to know all the owners. Like, there are other players playing the same game. Some of them will scale faster. Some of them are in a build-up phase, a sell-down phase. If you know everyone in their pieces, you have a lead on every property. And if you have these relationships and everyone knows your goals, which I always communicate in about 30 to 40 seconds early when I meet people, here's what I'm trying to build, and I appreciate what you've built. Talk to me about your business. Like, that's the type of conversation we have all the time.
Exactly.
So when I'm having these conversations, I want to know every single owner. I don't care how long they've owned it, how old they are, how much equity they have, the unit count. None of that matters to me. I am in the game of meeting other operators. And if you meet all the operators in your town and everyone knows who you are, your ability to find deals and contractors and property managers and lawyers and accountants, you get to use all the resources of all the other players. And that is how you master the real estate game, in my opinion.
Dude, think how we built our business down in Stephenville.
Yeah.
Our primary lawyer is like the legacy firm of the guy we bought our first deal from.
Yep. An owner was the guy who founded the real estate firm that we use in Texas. And I love that law firm. I love all the employees there. Their pricing is reasonable, which is ridiculous
For a law
lawyers.
firm, unheard of.
And they're really good. They're fast. They're good.
Love Jesus, which is
huge bonus.
Yeah.
Huge bonus. They align. They align with a lot of our perspectives on how the world works. But you have people who are like-minded, who are affordable, and who are very good. You build these relationships. Like, you don't have access to them. They're not taking on a bunch of new clients. They're a smaller firm. They're not tiny, but they're smaller.
They're not the biggest firm in DFW by any means.
To get that business, you need a relationship. Those type of things, that could be from any owner. Just happen to be someone who owned a 25-plex for us.
Exactly. Speaking on that too, finding new relationships. There's relationships I found in Stephenville. Need to be better keeping track of all of them. But people that own like 30 single-family houses, 40. Do I want to be those people? Absolutely not. The only way I found them was when we're trying to scale our property management company, Apex Asset Management, especially in Stephenville. And it's like, oh, you own a lot of single family. And on the software I've been using, Reonomy, I only see their small multi. And they might have 3 duplexes, but it's like, oh, you own 50 houses.
Yep.
And it's been interesting talking to them, talking through their business models a little bit. They're not looking for management at this point, but it's like, I didn't even know you existed. And so there's always people you can meet in that market. Granted,
exactly right.
Am I going to try to emulate the single family option? Absolutely not. Is it cool hearing their business model, exactly what they've done and how they've been there? 1,000%. That's another connection to the tool belt.
Okay, now next question here is I found a deal that is 7 1-bed, 1-baths, a 2-bed house, and a duplex. So it's a small portfolio.
Is it in Stephenville?
No, I don't think so. So you have what, 7, 8, 9 days. You have 10 total units. If I don't have sufficient reserves, we'll be going to sell off the duplex right after purchase to have reserves, if you can.
It depends on some things.
Yeah, but the first thing I would look at is, can I raise the reserves up front? And
if it's a good enough deal, probably yes.
Yeah. And so if you don't have the money, if you brought in an equity partner and they're paid out of the sale of the duplex, that would make more sense to me, because that buys you time. What you don't want to do is rely on a sale for reserves, because what happens if it doesn't sell? Or if you don't get the sell that you need? If you get stuck with it and you have a CapEx problem, you're just kind of hosed, which isn't where you want to be. So I recommend trying to avoid that happening. The easiest way to keep that from happening is to have the reserves up front. So I figure out a way to get the reserves on the front end. Another thing you can do, and again, it depends on a bunch of factors, right? How much cash flow do you have? Are you bringing on an equity partner? There's a lot of factors to it. Ultimately, I need to know how do I own it? How do I never lose it? And do I have adequate reserves to help me keep the property? Like, a big part of how you never lose it is having those reserves. I've done deals where you buy it and you buy it without a large enough reserve because you're like, it's an awesome opportunity.
I've been there multiple times and it's pain every single time.
here's what it ends up looking like. You have a few months where you cash flow, and then you have one that sets you back a bit. So then you're writing checks back to the property. And then the money comes in, and then the money comes back out. And then it comes in, and you're always chasing that reserve. The time it takes to build the reserve, you're always chasing that down. And then, 3-4 years into a project, traditionally, you're going to go through some sort of refinance. If you're buying, at a great price, that's typically what you do to return capital for a loan or an investor.
And you don't have to buy at a phenomenal price. We don't care about price the most, but buying good deals, I would say, more than anything.
Yes. And so you're stuck until you hit the refinance. And being stuck sucks. Awful. It's awful, especially on a small project. If it's like a 4-plex, you're like, I can't afford this renovation right now, but I can't lease the unit without the renovation. Now you're stuck in this death spiral of you just don't have enough money. And now you have to start flipping stuff, which is, again, I think that goes back to a lot of these online influencers saying, they're like, oh, the cash flow isn't real. It's not real if you don't have reserves. If you don't have cash flow day one, believing it will come sometime in the future and holding out can be too expensive for a lot of people if you don't know what you're doing.
Exactly. I've made the mistake, right? Like, you've made the mistake. I've made the mistake. It happens. But it's not being ignorant to the fact of, I should probably listen to the people that have been there and already struggled through this, and not trying to reinvent the wheel. I'm going to buy such a good deal. I'm not going to need this. Maybe your deal's phenomenal. Maybe it's the greatest thing since sliced bread. I don't know. Have the reserve anyways.
Yeah.
That's what I'd leave it with.
Yeah. That's what I think is completely accurate. And I'm not seeing a ton of questions. So there's a comment on this though.
So let's talk about Apex a little more too.
Yeah, absolutely. She said, yeah, it's a mindset switch. That was to the question about criteria for finding owners. Yeah, don't be picky with owners. If they own it, call them. We got another question here. I'm practicing. Oops, let me see here. There we go. I'm practicing finding good neighbors in any market. Am I right that the best neighborhoods in Stephenville are 10 to 5 o'clock based on income? I'm trying to figure out how to.
Let me see this.
So he's looking at finding good neighborhoods, but asking if 10 to 5 o'clock. 5 o'clock. I don't know what that means.
Yeah, I don't know.
I don't know how to interpret that question. I will tell you how to do this, though. On a smaller market, you're looking at the market as a whole. So for Stephenville, I'm looking at the market for a whole. Easiest way to drive a neighborhood, though, is you go down
Get in your car.
get in your car and drive the neighborhoods, because you can identify really quick, like, oh, all the housing here is low income housing. I know what the tenant mix is going to look like. This, I know what I'm looking at. If I'm in a neighborhood with nicer houses, I'm like, okay, so this is going to be a more upscale tenant. They're going to have more maintenance requests, and they're going to be like, you have problems with Class A tenants and you have problems with Class C tenants, and they're different sets of problems.
The Class A tenent problems are way different than I expect. Being one of them myself, kind of quote unquote now.
Oh, I don't.
It's
I don't
wild.
I don't like managing those. I actually like managing lower income housing because we're good at it, or I think it's a needed service. But when you're in an area, that's what you're looking for. So Stephenville, you have you have a lot of different jobs there. There's a lot of economy. But the two main things you have, well, three really. You have dairy, you have rodeo, you have the school. Those are the three main things. Dairy industry and rodeo, you're going to be farther out of town, though. You're going to be on all the outskirts of the town. As you get more central, you're looking at, okay, am I doing student housing or am I housing elderly people? Because generally speaking, those are your demographics, people who need to live near more of the amenities. They need to be closer in town. Or people who live right next to the school who are going to the school. So in that town, it's just, what tenant am I looking for? Where am I going to invest geographically? And then before you buy, drive the area so you understand what tenant am I serving.
And we've looked at deals outside of town in Stephenville. They're out there. They're kind of barn dominium things. They're a little different than our normal up our alley, but they absolutely exist. And it just depends where you're going to buy. It's more picking your problems than anything. You're going to have different problems being 5 miles out of town as you're going to have being next to the university with 30 students in your building.
Okay, so he's saying so if you're looking at about 5 or 10 o'clock, 5 and 10 o'clock, he's saying, like, if you're looking at Stephenville on a map, north to south, 5 and 10 o'clock being the highest income areas. I don't choose a market based on income, especially because I tend to serve lower
That's
income.
an interesting way to look at something, and it's not how I would look at something.
Yeah, because I don't need to rent to the wealthiest tenants. That's actually an interesting transition. So we run a property management company called Apex, and Apex Asset Management. We're picking up units all over because we are really good at what we do. Like I'm really
passionate about what we do.
Yes, I love managing better than the prior owners, and we keep managing in places in Texas where there's no other options. Like I'm looking at the other options. Their website was obviously made, by a 6-year-old, and they're telling us you can't get rents over $750, and then we lease to 5 people at $985 a month. People who don't know how to price, they don't know how to comp, they don't know how to lease, they don't know how to market. That's who we're competing against. So Apex, we really like, in particular, I really like the low income programs. Like we have a ton of experience in it. We're really good at Section 8. I'm actually running a master class this Wednesday, totally for free. You guys should register for
I'll
that.
actually be tuning in myself, so come check it out.
I'll drop a link on my Instagram right after this. I'll put it on my story, a link for it. I've never done this before, but Creative Finance and Section 8, it's how I set my pricing. It's how we set our renovation standards. But I'm not looking for the highest income areas. I'm also not looking for the lowest income areas.
No, you're not. That's not what you're hunting for.
I'm looking for neighborhoods and properties that can sustain low income housing. So I'm looking at, with Section 8 fair market rent, if we buy a property that is under that fair market rent and we can raise it just to Section 8 standards, and you can do it with or without using Section 8, but if I can use that fair market rent, FMR, if we got the property there, how much money do we make? On some of these properties, you're going to be like, oh, if I use that as my standard, if I get them to just Section 8 minimums, I make like $1 million.
Yeah, with Section 8 maxes, it's...
Or sorry, max.
Yeah, no, I get what you're saying. On the 44 unit, we're going to slaughter. And there's actually a few units we have to keep at like what, 30% of FMR
Yeah.
or something crazy. And that's part of the program. That's part of underwriting your deal. But as far as Apex goes, we're super passionate about low income programs, helping people out. There's a tenant we just placed actually today. We're adjusting roles and literally got the text from her. Thank you for helping me. Thank you for pushing me to do this. This is exactly where I need to be. And it's perfect. And it's like being able to help people like that. And it's not about the money. There's certain things that are bigger than money and bigger than business. That's what it's about. And it's also, we're passionate. We're multifamily owners. We get that most PMs suck, for lack of a better term, and how important it is to create that spread with whether it's higher rents, lowering expenses, doing all this stuff as your PM. We get it because we're owners as well. And that's the most important thing with our business model.
Yeah. Guys, that's it for the questions. And again, shorter unscheduled live. We don't usually go live on Mondays. I'm testing the gear to make sure everything.
Why not us? Why not us?
Yeah. By Wednesday, we're gonna have more going on as far as I'm gonna have these mics are actually gonna be active. We're just using the little tiny camera mic over there. The audio is gonna be better. The camera angles will be better. All the things will be better. I'll actually be able to see your questions on the big screen instead of looking at my phone. But I appreciate you guys watching this. If you guys want to see more, you guys want to attend these lives, it's 3:00 Pacific. Now that I'm in Texas, I'll start doing this in Central Time. But we're going at you every Wednesday, 5:00 Central Standard Time. I'm going to go live for an hour every single week. Would love to see you guys there. And again, I'll drop the link on my story. If you're watching this today, I'll drop the link on my story for the webinar. If you want to learn how we're using Section 8, not just in Apex, which by the way, if you have a deal in Texas, DFW all the way down to Austin, let me know. Happy to management.
Caveat there, DFW down to Austin to Stephenville. If you're anywhere near North Central Dallas, shoot us a message. We'll take care of you.
Yeah. But outside of just the property management company, I've used it on 25% of my portfolio. It's made me, we went back through it. These Section 8 strategies have actually made us millions of dollars. I've looked at the buildings I've filled with this and the new net operating income and how that's translated to my portfolio. I don't know why I haven't shared this earlier. It's one of 16 units that make up multifamily strategy. It's completely free. And I'm going to check it out. Everything. So yeah, come check it out. That's this Wednesday. That will be at 7 p.m. Central. So see you guys there. And yeah, like, subscribe, do all the things. We'll see you on the next episode.
Let's go.